Welcome back, best ever listeners, to the Horizon Podcast. Hey, I was just thinking, if you don't like the economy today, wait a week and everything could change. I'm just kidding a little bit. Anyway, I'm John Chang, and for those of you who don't know me, I've been active in real estate investing most of my life, and since 2007, I've led the research and advisory services team at Marcus & Millichap, the leading commercial real estate brokerage company. Now, I must mention, as I do every week, that I am doing this podcast independently, and what I say on the show doesn't reflect the opinions or positions of Marcus & Millichap. So, I'm going to dive back into tariffs just because the U.S. Court of International Trade ruled last week that President Trump's tariffs are not valid. Basically, they cited a couple things. Basically, the U.S. Constitution gives Congress exclusive authority to regulate commerce with other countries that is not overridden by the president's emergency powers to safeguard the U.S. economy. The court invalidated with immediate effect all of Trump's orders on tariffs since January that were rooted in the International Emergency Economic Powers Act, a law meant to address unusual and extraordinary threats during a national emergency. Basically, they said, look, we've had a trade deficit for 45 years. Why is it now a national emergency, right? And that was Trump's argument, that he said that the tariffs are justified because we have an emergency, a national emergency, because of the trade deficits with all these different countries. And so he's putting an end to it with the tariffs. The court didn't buy in on all this, and they said, nah, I don't think so. And as a result, they said, nope, can't do these tariffs. They're done. And in fact, you need to refund all the money that has been collected on the tariffs. I think that's about $50 billion so far that's been collected, maybe a little bit more. When you're counting in billions, what's a few hundred million here and there? But anyway, the point is they said the three-judge court ruled that this is not constitutional. This is in violation of the Constitution of the United States. Can't do it. President cannot usurp this power, even when declaring a national emergency, unless it really, really is a national emergency. And they said this one really isn't. So that was the ruling. Now, right after that, not long, that was appealed by the Trump administration, and an 11-member appellate court followed by saying that, hey, wait, stop everything. Both sides, you need to file briefs, blah, blah, blah. It's going to take a couple weeks to round this up. But here's the key. They said, while you're doing this, the tariffs can continue until we get this resolved. So this is eventually going to go to the Supreme Court. Everybody pretty much agrees on that. But in the meantime, the tariffs will continue. So effectively, there's no real change here, right? Yes, we have a ruling by one court that says, hey, this isn't legal, can't do it. The next court says, maybe not, I don't know, but we'll let it keep going until we get to a resolution. And so where does that leave us? Basically, no change. And in fact, if the past shows us the future, I would say that there's a good possibility that the Trump administration will slow play the legal process now, because they effectively got what they want, which is that the tariffs aren't going to be enforced, or, the shutdown of the tariffs won't be enforced. The tariffs are allowed to continue, which is exactly where they were before the ruling. And so they slow play this, all the way up through the Supreme Court. And in the meantime, they continue to do what they've been doing. Now, here's the wrench here. I think in a way this weakens the Trump administration's negotiating leverage with foreign countries. I think if you're another country looking at the situation, you say, yeah, maybe we don't need to make a deal in a hurry, because eventually the rug's going to get pulled out from under the Trump administration. Or you believe, okay, they're going to win this when it gets to the Supreme Court, so you're going to play ball. But I think it does, in a way, weaken the Trump administration's negotiating leverage over the short term. The other byproduct of this is that it increases uncertainty. And basically, the whole process will drag out longer. There's a lack of clarity on policy. We don't know how this is going to play out ultimately. Could all of the tariffs get refunded in the end? Maybe, maybe not. You just don't know. And so as a business person, you basically have to continue with the uncertainty model, which is I hold off on major investments. I hold off on development and construction. I hold off on building a new factory. I hold off on hiring more people, and so on. And that means, one, the tariffs will put upward pressure on inflation. And two, because the spending from businesses and consumers alike may slacken a bit, we have increased recession risk, and a byproduct of all of these things, more specifically with regard to the budget, and the need to print more money, basically, means we have higher interest rates on the horizon. So this is a little bit of a challenge for investors. It does kind of stall things out a little bit. It slows things down. And so, I think that this creates a little bit more hurdle than we had to begin with. Not a lot, but some. It doesn't make anything easier. How's that? So what about commercial real estate? Now, personally, I still believe that we're going to have turmoil. We're going to have uncertainty. I think we're going to have volatility in the stock market. I think we're going to have challenges with the bond market. I think the upward pressure on interest rates will devalue bonds. That makes bonds not such a great place to put your capital. And so, gold's already pushed up quite a bit in terms of its values. I don't know if it can keep going. It's possible. I don't know. I'm not an expert on that. But hard assets is where you go. And commercial real estate, I still believe, is one of the best options out there, whether as a private investor where you're putting your own capital up and you're buying your own building, or as a passive investor, or as a GP, whatever it is. I believe that putting your eggs into the commercial real estate investment basket is still one of the better options. In terms of what's happening with the tariff policies and the changes and the rulings by the courts, you get down to the bottom line. For apartments, I don't see a lot of impact unless we hit a significant recession that bleeds into significant job losses, and we see a spike in unemployment that pushes it up, into the mid to high 5% unemployment rate, maybe 6%. Then you start to see some impact on housing demand, as people lose their jobs, and you start to, face more headwinds getting renters. But overall, I like the demographics. I like the population size. I like the household formation. Yes, I have said, and I still believe that if we continue to see slumping University of Michigan consumer sentiment, and I'm recording this on Thursday the 29th. I think I get new numbers on consumer sentiment tomorrow, actually. But if we continue to see that fall, then it could slow down the household formation pace. But that's a delay, right? That's deferred household formation, not lost household formation. So it eventually comes back. My point here is that the outlook for apartments, I believe, remains sound. I think that we have the key forces in play to drive household formation that relies on apartments. And again, if we do see higher interest rates, that affects mortgage rates. That means home buying becomes even more expensive. The millennial generation is already pushing it back. The median age of the first-time home buyer is 38 years old. It was 36 years old 2 years ago. It keeps getting higher. And I just don't see the housing market picking up momentum anytime soon. I think that there's going to be a continued slowdown in home sales because of rising interest rates. I think that that's going to put a damper on it. Now, that means the retention of tenants in apartments remains strong. The new supply of apartments is already slowing down. I've talked about that before. The tariffs themselves will continue to slow construction. So new supply risks for apartments is going to diminish over the next few years while demand remains strong. And that's why I still like apartments in this climate. Again, we could see a slowdown in absorption. We've had really good absorption for the last 3-4 quarters now. And I think that we could see a little bit of a slowdown in the second and third quarters. Really the third going into the fourth quarter is really where I see it. I think second quarter, we'll get data here in a few weeks for the second quarter. But I think the absorption numbers are still going to be pretty sound in the second quarter. Third quarter, I think, is when we would see the slackening if we continue to see a slide in consumer sentiment. So that's a short-term risk. But again, that is household formation deferral. We're not losing households, and therefore, ultimately it plays through. Looking at retail, again, I've talked about this before. There's going to be winners and losers, right? The ones who are highly dependent on imports, that are tariffed are going to face headwinds and risks. Walmart has already said, look, prices are going to start going up. They said end of May. We're at the end of May. Let's see what happens. I don't think it's going to be so material that people notice it right away, but I think it's going to seep through the commerce and the retail sector over the course of the next 3 or 4 months. And I think that it's going to be kind of a, boil the frog slowly kind of syndrome, where, you don't realize that the temperature is getting hotter and hotter because it's going up slowly. And I think that's how the tariffs are going to impact pricing, where we see the rising costs, but they're not going to be huge or highly visible, but they will get picked up in the CPI numbers. And now, there are some retailers who are going to be more impacted than others. I don't think your local grocery store or even, really when you look at the grocery anchored retail center, maybe it has a gym or fitness. Maybe it has an eye doctor. Maybe it has an urgent care clinic, has a few restaurants. And, most of the retailers in a neighborhood shopping center are not selling goods. Unless you have a Five Below, in that shopping center, you're really not looking at a significant impact on those types of properties. Shopping malls, different story. But, most of our clients at Marcus Millichap, most of the investors out there, most of the private investors are not out buying shopping malls. So, I think the impact on commercial real estate investment, in retail will not face any significant headwinds. Now, there have been a little bit slackening of demand in retail in the first quarter. We did call out negative absorption in the first quarter after 17 straight quarters of positive absorption. So demand for retail might be slackening, or that's a 1 quarter anomaly. A single data point is not a trend. We have to wait until I get my second quarter numbers. And again, the retail numbers probably come in, for me in the third week of June. presumably. So I won't be able to quantify this until then. But again, we still have very low vacancy rates in retail. Basically, first quarter this year and first quarter last year have the same vacancy rate. We're not seeing any big movement. It's really minor movements right now. Office. Now, office, I could make an argument for office in a recessionary climate. The reason is that, part of the reason I believe so many people are working from home is because they can. Do they need to? No. Should they? I think that in a lot of cases they really shouldn't be. I think that the productivity, I'm inclined to agree with a lot of the the leaders in the finance sector, Goldman Sachs, a lot of these big companies in that sector. We've seen it some in technology where they're bringing their employees back to the office full time. I don't know that you necessarily need to have it full time, but generally speaking, I think people are going to be more productive if they're working in the office. Most people, right? I know there's a lot of people who work from home 5 days a week. They're very productive, do a great job, no issues, right? Great. But I think for the majority, there are advantages to be in the office, company culture, relationship development, career development, collaboration, and the ability to partner with other employees of the firm to create something bigger and better. And so arguably, if we have a recession and the unemployment rate starts to rise, then arguably the workers have less negotiating leverage and the companies have more negotiating leverage. They have more employees to choose from and they can pick the one that is ready to work from the office, whatever, 3 days, 4 days, 5 days a week, whatever it is. So arguably office could get a boost from a downturn in the economy. Not saying it will, but I could see that argument play out. Industrial, West Coast ports face probably the most risk, especially if they've already overdeveloped. The Inland Empire and Phoenix come to mind right off the top. I think that the ripples of the trade war, the supply chain disruptions could weigh on the performance of markets like the Inland Empire and Phoenix, maybe even into LA, although the vacancy rate in LA tends to be very low. But the port of LA and the port of Long Beach really have the most to lose in a trade war with China. So, I think that there could be some ripples from that. But most industrial, especially infill industrial or local service market area industrial, the industrial warehouses that cater to the local population in a given metro, those ones I think will be fine. I think that we saw a buildup of inventories at the beginning of the year to get ahead of the tariffs. I think that the demand for industrial slackens a little bit as people and companies start to thin out their inventories and wait for the judgment from the Supreme Court or whatever it takes for the tariffs to be rolled back at some point. So I think that the inventories go lean for a while as a byproduct of what we're seeing with the tariffs. And so industrial gets a little bit of a setback. That said, construction is going to fall for all property types. Again, that affects industrial just as much as anything else. And so we see a slowdown in supply risk. And it doesn't take as long to put up an industrial warehouse as it does to put up an apartment building or some of the others, or a large office or a retail center. But nonetheless, I think that we get a reprieve from the overdevelopment and the fundamentals eventually start to stabilize and strengthen for industrial over the next few years. So that's where I see these pieces landing. I think that, I want to talk a little bit about the investment climate. And in reality, I think that that's the step over into the horizon segment of the podcast. And that's where we're looking forward, right? We want to look forward 5 years. And as part of that, I really kind of focus in on one thing right now. Is now the time to buy and sell commercial real estate? And, the reason I get there is because if I buy now, my hold period is roughly 5 years, and that's pretty common. That's probably the average. Actually, the average is actually closer to 7 overall for the hold periods. When I did the math last time, we basically went through and matched up all the properties that have sold and went back and looked the last time they were sold. And the average was about 7 years. So that was the average hold period. So if you buy today, you're looking at an exit from the property in 5 to 7 years. And that is the horizon. So does it make sense to buy today? But before I talk about that, I want to talk about the other side of the coin. Should I sell now? And so I think that's actually a really interesting question. And so there is a lot of capital stashed away in properties that have been held 7 years or more. Not because people planned on holding them for 7 years or more, but because people have been waiting for the prices to rise. And so they've been sitting on these things. They're cash flowing. They feel good about them. They like the properties. But I think that there's going to be a rule change, and this is going to affect buying and selling. And I think it works to some people's advantage to sell property now. And that is that the bill, and I don't love this term, but the one big beautiful bill passed through the House of Representatives, the new tax plan, basically, which renews most of the 2017 Tax Cuts and Jobs Act features. But one of the features that I think is really important is the bonus depreciation rule. And we put that in place in 2017. It lasted a few years, I think 4 years, until 2021, I think, where you had the 100% bonus depreciation, and it's been winding down since then. And so now I think it's at 20% bonus depreciation. And don't quote me on that. That's me talking off the top of my head from memory. So if I missed on some of those numbers, forgive me. But the point is, if this new bill that has passed the House of Representatives makes its way through the Senate and gets signed into law, I do believe that bonus depreciation, that 100% bonus depreciation carries through. I believe that gets signed off on. And as it's written in the bill that passed House of Representatives, that would be a retroactive to, I think, mid-January. So if you sell that winner, right? You've been holding it for 7 years. You sell that one. You pay off all your investors if you're syndicating, or you put the money in your pocket, or you pay your taxes, your capital gains, or you turn around and do a 1031 exchange. But here's the thing. When you go buy the next asset, when you 1031 exchange out of that winner and you redeploy the capital into the next property, you're resetting your bonus depreciation of 100%. Now, if you 1031, you carry your depreciation over, as I understand it, from your last asset. But if you buy a bigger property, more expensive property, which you pretty much have to do with the 1031 exchange, then you get to apply the difference in the bonus depreciation. That's my understanding. I am not a tax accountant. Please check with one. Don't take this for rote. But basically, this bonus depreciation is a big opportunity. So you sell now, you collect your winnings, and you go in, you redeploy into a new asset, perhaps a better asset. and you get that bonus depreciation, which is going to boost your first, second, third year returns. Depending on how much you have, this could carry over from year to year, I think. But regardless, you're going to have a bonus depreciation in that first year where your margins are very thin. And the reason the margins are thin is because the cap rates are not that much better, not that much higher than the cost of borrowing, maybe even lower. The cap rate may be lower than your cost of capital, your debt capital. But this bonus depreciation could make a difference. And it could nudge you from being marginally negative on the asset as you go in and turn your first year into something marginally positive. And that would be a good thing. So I think that you redeploy your capital on your winners. Or if you have a loser, a property you don't like, it's an opportunity to get out of that and redeploy the capital into something better. And again, get that bonus depreciation. So look, I have a property that I don't love, and I am planning to sell that one and redeploy that capital, use a 1031 exchange, put it into something that's going to perform better. I don't know what it is about that one property, but it just seems to underperform. Whatever reason, the tenants there just are never as good as some of the other properties I own. So that one is just a dog, and I'm going to get rid of it at some point. But arguably now is a better time than later because of the interest rates, which may be pressuring up, and they will probably go up faster than the cap rates. And therefore, is now the time to buy? Arguably, not bad, especially if that bonus depreciation comes into play. So when you think about it, yes, we're going to have turbulence over the next year. Look, like I said at the beginning, my little joke at the beginning, right? If you don't like the economy today, wait a week and it's going to change. I almost feel like that's going to be the nature of our climate for the remainder of this year, maybe 2 years, maybe 3, maybe all the way until the next elections. I don't know. But my point here is that we're going to have a bumpy ride, I believe. And I think that we are going to face upward pressure on inflation. I think we have recession risk. I think we have higher interest rates in the pipeline. And as a result, now may be a better time to move than 3 months from now, 6 months from now, however long forward, it will take you to make a decision. Inevitably, people wait too long. A lot of people do. So anyway, 5-year plan, you're fine. I believe. Again, the long-term drivers I've mentioned, the demographics, the earning power of millennials as they enter the strongest earning years of their career, their greatest spending years of their career. I think in medical office, seniors housing, there's advantages because of the aging baby boomers, although I think one thing, and I mentioned this on somebody else's, Adam Gower's podcast where I was on with him actually earlier today. One of the things I did mention is pay attention to the employment of assisted living facilities. The immigration rules could play a big role in their ability to get the right people as employees, in medical services. So, just like construction, a lot of the people in medical services are non-Native Americans. So if we see reduced immigration to the United States, that could weigh on the performance of some of those types of properties. But I think the demographics play through. When you look at a 5-year hold pattern, 7-year hold plan, I think the demographics, the long-term drivers play through. Is the U.S. economy facing a bumpy ride for the next few years? Absolutely. But is the U.S. economy resilient? Absolutely. Is it the biggest economy in the world? Yes, by far. So don't bet against the U.S. I think that there's too much positive momentum in this economy. Even if we do have a turbulent ride, even if we do see some things get changed and maybe they don't work out as somebody may plan that they are going to, that ultimately the economy will be fine over the long term. We've been in recessions before. We had the global financial crisis. We had a pandemic, and we recovered from each of them every time. So when you look out 5 years, 7 years, yes, it took a while to recover from the financial crisis, but that was a very unique, very severe recession. I do not foresee anything like that this cycle. Possible, absolutely possible, but I don't think that is the highest probability case. So we bounce back. Maybe it takes a year, 2 years, 3 years, something. But by year 5 of your hold, you're in good place, right? Because I think that the recovery, if we do have a recession, I think we will have a strong recovery out of it. Again, driven by the demographics. So is it better to wait? Don't buy, don't sell, sit on the sidelines, wait for another year? Maybe, if you can. But I don't think you're going to be looking at a better situation a year from now than you have today. In fact, it could be worse. I think that, literally, I just heard somebody talking about interest rates pushing up really dramatically over the next couple of years, which is entirely possible. If you think about it, if you had to place a bet today, what would you say? End of this year, interest rates are going to be higher or lower? In 18 months, in 2 years, higher or lower? Hard to tell, and guessing interest rates is a tough game. But if you had to place a bet, where would you put it? And then roll it back into your thesis on investing and look at the lag time between the movement of interest rates relative to the cap rates, and you might find your answer there. So that brings me to a wrap up here. I think I've gone about my regular 30 minutes, just a little over. So there you have it, best ever listeners. And of course, I want to thank all of you for joining the Horizon podcast today. I'll be back next week on Sunday and every Sunday with whatever real estate insights happen to pop into my head. I'm going to go round up some of my buddies and try to bring on some really smart guests for you over the next couple of weeks. We're kind of getting out of conference season, so I'm not going to be traveling as much. So it gives me a little bit more time to think ahead and rally up some of the people who are the smartest people in the business that I know, and I'm going to drag them back into this podcast for you. So stick with me. I hope you're enjoying this, and I will catch you later. As always, keep your eyes on the horizon.